Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, and we are so lucky to have the pleasure of speaking with Anna Kelly this morning. How you doing, Anna?
I'm doing great. Always good to be here with you Wednesdays.
Yes, so it is Fed Day. We are going to know in just a couple of hours what the rates are going to do. We're going to talk about a dot plot ad nauseum. We'll hear about a hawk or a dove Powell in the Q&A. But what I want to talk about with you today is something he said in Jackson Hole.
Yes.
And I think he's actually said it twice, but I think people heard him the second time. He kind of
Yeah.
got lost the first time. And that is basically pain is coming.
Oh, yes.
I hope in the Q&A today, or maybe in his prepared remarks, he defines what pain is. I hope one of the reporters has the balls to ask him. But I thought you and I can sort of talk about what we think he means by pain is coming, because I think a lot of people have opinions. But you and I have been through this a lot. So let's play ping pong, go back and forward. You're the guest. What are some things that you think he means by pain is coming?
Absolutely. First, I'll just say that Powell is serious. This last speech was the first time, I believe, in history that a Fed chairman came out and used the word pain, not only once, but twice. We are going to experience pain. Unfortunately, this is going to be painful, right? He is all but saying in Fed speak, this is not going to be a soft landing. We hoped that it would be, but the reality is, as we continue to rise rates, we are going to do some destruction to the economy. We know that we're going to start killing housing demand. We know that your credit card interest rates are going to go up. We know that your car payment interest rates are going up. We know that this is basically going to lead us into a recession. You're going to start killing wages. And he's essentially said that, but the people and the markets are misreading him. They were kind of making a bet that he's talking tough.
Yeah.
Get us to react, but they were banking on the Fed put and saying he's just talking tough. He doesn't really mean it. But what he has said is essentially wages are out of a line with the fundamentals. And so in order to get our economy back to where people are spending less, he's got to destroy jobs. Everybody's talking about real estate and the stock market and what it does there. But where it really hurts people is not only does it make housing more unaffordable, but really they're looking at this as a demand pull inflation. And what that means is that the demand continues to pull prices up. First, they said it was a supply side issue, and it partially was. But he's basically saying all we can do is kill demand. In order to kill demand, what we've got to do is we've got to get people spending less. And if rate hikes alone aren't getting people to spend less, we've got to start killing wages so people have less money to spend. How do you kill wages? You make it less affordable. Prices basically become unaffordable. People stop buying. Then companies have to cut their profit expectations. Then companies start laying off. They start hiring freezes. They stall your wages. And that is how they try to get the demand down, is to kill wages, bring up unemployment so that there's less demand. And unfortunately, that's going to be extremely painful for the people. But he's not going to come out and answer the ballsy question and say, yes, we're going to cause unemployment. Yes, we're going to cause the American people to lose jobs. They're not going to admit it. They're just going to say, this is going to cause some pain. We are probably heading into a recession. They haven't admitted that we're already there. But to me, that's what pain means. The worst is coming.
Yeah. For me, when I kind of think about it, I see pain at multiple layers. First, asset prices, right? We saw a lot of assets, almost every asset, go up to crazy values and at great speed.
Yes.
Because again, the risk was zero, right? The cost of capital was essentially zero.
Yes.
We still have zombie companies, right? So not only, so again, I think asset prices come down, like risk assets come down. Two, I think the biggest thing is we're going to see the unemployment. Like if you want to look at a monthly number where pain is, it's unemployment, in my opinion.
Sure.
We went from 3.5 to 3.7 in the last print. It would not shock me if we're at 4.5, 4.6, 4.8, and that's millions of people. That's pain.
Right.
I think we see more bankruptcies. I think we have a lot of companies that borrowed in the market when corporates were zero, that are frankly walking zombies. Now, They may be acquired. They may be acquired for pennies and intellectual capital and, frankly, labor. But there's going to be a lot of companies that no longer exist in the next 12 months because rates are going higher because the capital window is closed.
Correct.
We are going to see housing. I mean, housing is something I talk about all the time. The transactions are already down roughly 30%. They're going to go 50%. That's going to, right? Housing is 15, 16% of our GDP. If that gets whacked in half, we're going to go into housing-led recession is coming, in my opinion.
Sure.
And yeah, and the other thing we got to realize is higher rates mean stronger dollar, and there's going to be so many ripples across the world, right? Sri Lanka is probably the most obvious example in the recent memory where their dollar-denominated debt became a problem, and revolutions happened, or riots, and this is that's not going to be a one-off. There's going to be a lot of pain, and it's going to hurt lots. It's not going to be only on the U.S. shores. This pain that
Right.
Powell speaks of will be worldwide pain, in my opinion.
Right. Oh, absolutely. And their mandate is to really focus on the U.S. economy, but they very clearly understand that as the U.S. Dollar is the world reserve currency, and required collateral, by the way, for a lot of derivatives and debt.
Yeah.
That this is going to cause a lot of people to leave other foreign emerging markets, continue to try to invest in the U.S. Even though there's pain in the U.S., it's less painful than it is global. But I think that there's not only pain for corporations, as you mentioned. I think the last number I read, was that the NASDAQ had 25% zombie companies, 25%. And what Michael means by zombie companies is essentially their debt can't be covered by the revenues that they produce, by the net income. So they
profit
in a negative, and they just continue. They've been able to just continue to roll the debt with variable interest rate debt. And so most corporations do not have fixed debt like the average investor does. They don't get 20-year mortgages. They get a rolling 1, 3, or 5 year. And so Powell has been warning for almost a year now, 10 months. We're going to raise rates. We're going to raise rates. That was kind of the warning call to tell corporations, get liquid, refinance your debt now. We're going to cause pain. But no one in the markets really believed him because they're looking at the underlying fundamentals of the economy. And they're thinking, even if you get to 5% unemployment, it's not historically horrible, right? They think the wages are higher, unemployment's low. That in and of itself, they believe, shows a strong economy that can bounce back from these Fed rate increases. But as these companies did not recollateralize their debt, there are still a lot of companies that were banking on higher spending to offset that debt, even if they had to roll it at higher rates. And now we're seeing inventories increase and really spending come down in a lot of discretionary product type companies. So yes, food, energy, housing, they're up substantially. And that's the biggest place that it hits the American's pocketbook. But when you come to disposable income, people buying clothes every time they go to Walmart, people buying shoes on Amazon, people buying electronics, those things are down quite substantially. And so these companies far underestimated where things can go. And I believe, I'm not very much in the stock market, but I watch it very carefully. I think we're in for another 20% fall in stocks because companies are going to experience the same pain that people are. And one other thing to throw out there, this is an interesting statistic that I was just listening about from an economist that I follow yesterday, is that, while we are in $8 trillion worth of debt, we have almost 40 trillion, bigger than trillion, $40 trillion plus of derivatives, right? So derivatives basically have to be collateralized by US dollars. And so there could be potentially more pain, not only a recession, but a financial system crisis mirroring 2008 because of what's going on in the derivative markets and the fact that it has to be collateralized by US dollars while US dollars are being pulled out of the system and those rates are going up quite substantially. And so I think that there really is the potential for some serious pain in the US economy, far from a soft landing, really probably a hard landing. And if the derivative markets and all of this debt doesn't get unwound very, very carefully, we could see some mass deleveraging events, mass bankruptcies of a lot of different US corporations and financial corporations who are trading in derivatives.
Yeah. So let's close this on this has been kind of a negative. You and I don't normally do these, but when you talk about pain, it's always negative. But let's flip the script, close on a positive note. What are you doing in your micro world, your family, your investing world? You already talked about, I think in episode 1 or maybe here, about buying I bonds, getting that 9%, which I'm going to go do today, UStreasury.gov. What are other things you were doing to take advantage of pain? Because again, as the tide goes out, there's going to be opportunities. And you and I have been here before.
Always. So number one, when we talk about these painful things, it's so that you aren't blindsided like we were in '09, like many other people were. So I am really shifting a lot of my focus on buying assets for preservation of capital, right? We buy assets for 3 reasons. We want income, we want growth and appreciation of our wealth, and we want to preserve what we have. When we're nearing the bottom of a cycle, and we're nearing the bottom, but not there yet, we need our number one focus to be preserve what you have. Rule number 1, Warren Buffett says, never lose money, right?
Yeah.
The second thing is be greedy when others are fearful and be fearful when others are greedy. So both of those are, chiming daily in my mind. I'm not doing average okay deals for today. I'm not buying something at a 5 or a 6% return, because if the economy starts to falter, that looks like 1 or 2%, right?
Yeah.
So I'm not real thrilled with that. So I'm only doing great deals that I believe are in markets and areas that are going to bounce back from this next 2 or 3 years of pain, that values will over time continue to go up, that I can really cash flow consistently, and that I'm going to preserve my value. So there is no better time to be in real estate. It's one of the safest places we can be for long-term rentals, because what's going to happen, Michael, no matter what happens to the economy, all these companies that start to hurt, people need housing. It's one of the highest needs on the Maslow hierarchy of needs, is we need a place to live. And so I'm thankful to continue to be able to provide housing. I'm looking for more ways to provide housing, more properties to buy, but I'm not being aggressive with my numbers. It's got to be very conservative. I've got to build in a buffer for people not being able to pay rent. My vacancy, I'm building in a higher buffer. My collections losses, I'm building in a higher buffer. And I'm making sure that I can at least cash flow, at least a break even, plus have some upside in the property, buying really great deals for today.
Yeah. Again, the whole idea is to buy great deals. It's also very important to do the work. My greatest fear, not for you and I, but for people that watch us, is they're going to see this scary environment and sit on their hands and cower. This is not a time to sit on your hands. This is the time to double down and do the work. I'm not sitting here telling you to do a deal. I'm sitting here telling you to do the freaking work. Figure it out. It's always a great day to do a great deal. Most of you have no idea what a great deal is. That's a problem. That is your problem. If you don't know what a great deal is in your market, in your buy box, that's on you. Anna and I both know what it is, and I have no problem doing a deal today if it's a great deal in my buy box.
Absolutely. Yeah. Do the work consistently. It's kind of like, financial advisors will tell you to dollar cost average in the stock market, right? You have to know what you're doing in order to do that. But I dollar cost average with my real estate. Essentially, I'm buying what looks like a great deal in every market and every time. And I'm looking at what could make my numbers derailed over the next couple of years. And can I weather that? And can I come out on top for the long haul? So do the work, like Michael said, every single day. You'll start to see when deals become great deals, because you're doing the work every day and watching what happens to values.
Awesome. Anna, and where can people find you?
Great. You can find me here every week on our channel. You can find me on social media at Anna Kelly, REI Mom, and you can find me at reimom.com for coaching and mentorship.
Awesome. Thank you so much.
Thank you.